China has cornered the gold market. That's what it boils down to. Because it's not just China. You've got India, which has got massive amounts of bullion held in the form of jewelry. I mean, most of the Chinese public gold is actually jewelry as well. And you've also got Russia. Now, I understand on pretty good authority that Russia's got 2 sovereign wealth funds, which have a total of about 10,000 tons of gold between them. And then you've got the Russian Central Bank, which has got a further, 2.3 thousand tons, whatever. You've also got the whole of the Shanghai Cooperation Organization and BRICS, all their central banks. Presumably they've got sovereign wealth funds as well. Now, all this is meaning that the liquidity we have here is minimal. Now, let's look at the demand side. So far, this hasn't mattered because nobody wants to buy gold. I mean, any investment manager isn't going to earn fees by putting his punters into gold. He would rather put them into something which is going to pay him a bit more. And not only that, but the regulators are on his side. The regulators turn around and say that physical metals are not regulated investments. But of course, this was why they said they set up ETFs, to get around this regulatory hurdle. But the ETFs are beginning to grow. People are beginning to buy into them slowly. But the other thing, which I think is very important on the demand side, is that we now see analysts at the major US banks turning around and saying, we believe gold's going at 4,000, whatever their reasons. I don't care. I mean, they don't know what they're talking about. I reckon that's my default assumption anyway. But, the fact that they are saying it, and the fact that the investment managers within those banks, who are typically managing or responsible for over $1 trillion, we're looking at banks like Goldman Sachs, Bank of America, Citibank, Citicorp, whatever they call themselves now, etc. We're talking about huge numbers. They haven't got any. I don't think they necessarily know how to get it, actually. I mean, so that, this is interesting. When you look at the complete investment management universe around the world, it is estimated that portfolios are worth some $300 trillion. $300 trillion. Now, gold ownership of that, you just look at ETFs and maybe sort of make a few assumptions about, bullion being stored and so on. But, basically it's ETFs and nothing else. It's less than 0.5% of that. I mean, it really is. Less than 0.5% is in gold. And yet you've got these behemoths in America now thinking, oh, we better buy some of this. Now, to put it into context, my China story suggests that the amount of liquidity, which is unspoken for, including jewelry in the West, is probably in the region of about 40 to 45,000 tons. That's all. That's it. We can see what's in the vaults. We can't see what's in the Swiss vaults. That's something I don't know. I would, someone gives me a number, it'd be super. But I think quite sensibly, the Swiss don't produce these numbers. That's what I would assume anyway. But it does mean that if a 1% increase in allocation, portfolio allocation of that 300 trillion was to take place at current prices, you're looking at 25,000 tons. Where's it going to come from? I mean, the answer basically is that we're heading for the most enormous crisis in the gold market. And the figures are very different for silver because being an industrial metal, etc., but the same principle applies. The liquidity is just simply not there, which is why it's sort of hurtling up $1 a time at the moment. This is a squeeze on the system. And, this is very serious. And I think so, I can understand your punter selling off, $1,000 below the current level and maybe living to regret it. But, I can understand that. But the bit he's missing basically is he's going to be out of the market on the biggest, sharpest squeeze probably seen in history. I think that's where we're heading.
Yeah, and as you rightly say, Alistair, where is the gold going to come from to meet this sudden demand? And you're talking about institutional money here looking to get involved in gold. And I mean, as you say, so 0.5% is how do you even move up from that point? How do you even look to buy 25, 30, 40,000 tons of gold? I mean, it is going to require at least that amount of gold. So it's not coming out of China. It's moving into China. And
is that the futures market is being used as a means of delivery. I mean, I don't know if you saw, but the stands for delivery yesterday were, I mean, in gold, it was something like 66 tons.
Yes, it was.
Just in one go. Silver was
still
huge.
24 tons, still 24 tons to sell, to deliver.
Yeah. And silver was huge too. I mean, that was 1,500 tons or something. I did work it up. I can't remember what it was. But this is enormous. I mean, what it means is that the gold that's been delivered this year, or stood for delivery, this year has totaled about $950. 950 tons this year alone. And if we're looking at silver, I think the figure is something like 11,500, 12,000 tons. I mean, these are enormous numbers. They really are. And, you're looking at, in the case of silver, you're looking at, something like 58% of global mine production, which is what, 800 million ounces. I mean, what is going on? I mean, you've got to go and buy a future in order to get your bullion. This quite clearly shows that there's nowhere else you can go and get it. Now, that having said, I do understand that the retail market is slightly different. And there are interesting cross currents there. I mean, I understand that, Krugerrands are readily available and in great big quantity. And when it comes to kilo bars, I mean, you can buy those quite easily, sort of 1, 2, 3, 10, whatever. That's absolutely no problem. But as soon as you go out and beyond that sort of the wealthy retail market, as it were, it then gets extremely difficult, as I understand it. Is that your experience as well?
100%. The larger the size, the more the premium.
So, I mean, this is the way it's going. And, going back to the 1% portfolios is 25,000 tons. I mean, where the hell is it going to come from? I mean, the answer basically is that the gold price measured in fiat is going to spiral out of control. And then, of course, you've got the implication about what is the value of fiat. Now, we all turn around and say, well, is gold going up rather than fiat going down? Yeah, but that's going to force the Chinese, I think, into a situation where they have got to start considering sooner rather than later a gold standard to protect their yuan, because their yuan will be going down along with it. I mean, unless they protect it. And the other thing, which so far nobody, I think, actually understands, is that when you get the end of the fiat currency system, essentially, you're predicting the collapse of their purchasing power. Everybody in the investment management industry thinks that, okay, inflation's a bit sticky, but it'll probably come down next year. We're going to get cuts in interest rates. Wrong. Prices are going to rise hugely. But of course, the thing that nobody really appreciates is it's not prices rising, but it's the purchasing power of the currency collapsing. I really do think we're in for a period which looks like replicating what happened in Germany between 1922 and November 1923. We'd already had a post-war decline, I mean a substantial decline in the purchasing power of the Reichsmark. It steadied between 1920 and late 21, when there was a stock market crash. We've got a credit bubble here. That's going to crash. So this is actually a replication, if you like, of end of World War I, end of COVID. Okay? Purchasing power of currencies goes down. In other words, we saw inflation rising, interest rates rose with it. Now it is stabilized. And we've got a lovely period of anybody who's got anything in the stock market is doing wonderfully, thank you very much indeed. Making lots and lots of money with his Nvidia and his Bitcoin and God knows what. That is just absolutely the same as 1920 to 1922, the end of 1921. And what follows, we're about to see. And this is similar. I mean, it was the end of the Reichsmark, and it's going to be the end of the dollar and all other fiat currencies that sail with it. And what that means is, I mean, if you look at what happened, I mean, all the stories about, wheelbarrows full of cash and all the rest of it, and the complete collapse of values. I mean, like property, people making money. I mean, one way in which you really will make money as a manufacturer is to manufacture to export to Russia. Because Russia will go on a gold standard the moment China does. And what you'll see is your manufacturing costs sinking along with the currency, but your margins protected when you get paid in rubles or yuan. I mean, that's what Hugo Stinnes did, the inflation king, back in 1922 to 1923. He became the wealthiest man in the world. And basically his costs were in collapsing Reichsmarks, and his profits were in gold-backed dollars. And he owned something like a quarter of all German industry, when the thing ended. And Fritz Thyssen was another one. Now, Thyssen is a name we know from the steel industry, and that's still around. So this is damn serious. What does it mean, for the gold price? Well, in a sense, it's irrelevant. What's really relevant is the moment people wake up and understand it's not prices going up, but their currency going down, then they will dump their dollar deposits, their credit, if they've got any banks, and don't tell anyone you got it. Silver, I think it would be a lot harder for them to confiscate that. I really do. So that makes silver especially attractive in this collapse scenario. And also, it's probably, I mean, I don't see necessarily that we'll be going out and spending our gold or whatever, because that's not the role of gold, really. What we will do is we will find, our currency, we will liquidate whatever gold we need for currency, whatever its value, as it's needed. And you'll be able to buy a nice big mansion and country estate and all the rest of it for, sort of 10 ounces of gold. That's what happens. But you need to get your Britannias, maybe. I mean, if you can get someone to accept your Britannias, they'll probably bite your hand off, but then you can buy all
no capital gains tax either. So
not on that, no, or on sovereigns.
Yeah, which is again amazing, because I sometimes say to people, look,
don't tell Rachel. Don't tell Rachel.
Yeah, exactly. But I think, maybe if you're going to buy a single kilo of gold, why not buy the equivalent in Britannias or in
exactly.
sovereign?
I mean, the premium's only 2 or 3%. It's
I know. It's nothing, absolutely nothing. And then you've not only that, we're living in a communist regime here, and they're coming after anyone that's got any wealth. And we don't even know how that's going to roll out, shortly. But this is really timely, because I think what you're saying here, look, wake up, because this is real. It is a problem. It's going to happen, and obviously there is an opportunity, and especially you talk about gold and silver. I mean, look at every other currency, every other fiat currency that prices gold and prices silver has been through the roof a lot, led the way higher. And I look at CNY silver, Euro silver, forget 2011 highs in dollar silver. It's through the roof. It's just every day. It's higher and higher and higher. If anyone wants to me, I'm saying to everyone right now, why would you not go after swap some dollars for silver now because it's so clearly, it's your arbitrage. It's quite clearly undervalued. They've been sitting on it a long time. There's obviously a lot of short stops above the market. Otherwise, they'd have raised the margins on it by now. And it's a panic. So it's, to me, that's what I'm saying to people right now. Right, what should I do right now? And I'm agreeing with you. Silver has to be a bargain.
Yeah, oh, absolutely, and I mean, there's absolutely no monetary use priced in it. I mean, you've got a gold silver ratio of 80 odd. If it was going to be priced properly as money, you'd be looking way below that. I don't think we get back to the sort of Sir Isaac Newton 14.5 ounces of silver to 1 of gold type thing, but I can easily see this below 30. In this sort of panic. And that does give you, sort of huge outperformance. And of course, the other thing is that while the institutions might be fretting about where the hell we're going to get all this gold, the average investor, the man who feels that he's missed out on the gold run is going to go for silver. He's bound to. Because apart from anything else, he doesn't have to fork out the thick end of $4,000 for an ounce. He can buy an ounce for around about 47, 48. So that is extremely attractive, I think, to most people. So I do see a bit of leverage there. The other thing possibly is, I mean, I think that institutions will go for gold mines and silver mines and so on. And I think the overall mining industry, I think, has been very, very suppressed in terms of its value. If you look at the main indices, they're more or less, talk about mining's, gold mine index or whatever. They're more or less doubled from the bottom, but this is from very, very depressed levels. But it does mean that you've got to have the ability to analyze mines or at least know who to follow, which is probably, what most people will do. That introduces a degree of complexity, as well as that. If you buy into stock shares, whatever, I mean, basically you're buying credit again. And now I know people think that, a company isn't inflation proof or, it proves gives you some protection from inflation. But the problem there is that it is still credit because what you're doing is you're buying into a management promise to give you a stream of dividends. Well, they don't even pay that nowadays. So
you're just treading water then. You're just treading water. You're not doing anything.
Yeah. I think the key to it, Andy, the key to the acceleration in the market is going to be when this credit bubble pops. I think we're within months of it. I mean, in fact, I think it probably happened by the year end. October seems to be, and here we are on the 1st of October, it seems to be a pretty good month for a crisis, for an autumn crisis. So anyway.
What Andrew and Alasdair are really surfacing in these clips is that we're late in a long monetary cycle, and the metal that most investors still treat as an afterthought, silver, sits where asymmetry lives. Gold gets the headlines, but silver is the tight spring. You can hear it in the way they talk about liquidity and delivery. The market's telling us that paper claims and physical reality are parting ways, and that divergence is usually where historic repricings begin. If you need a near-term translation, in 2025, both gold and silver blew through old ceilings as investors scrambled for havens, not just because of CPI or rate cut odds, but because trust itself is wobbling. We've had multiple fresh records for spot prices this month, with silver cresting to all-time highs alongside gold's surge over $4,300 per ounce, and mainstream desks now openly talking about $5,000 gold over the next year or so. The point for silver holders is simple. The little brother is finally trading like a monetary metal again, and a scarce industrial input at the very same time. Step back to the fundamentals that matter for silver, and you'll find two forces converging. First, the monetary bid. Central banks haven't been buying silver, but their gold accumulation has broken investor psychology wide open. If the stewards of fiat are hedging fiat, private money follows. Official sector gold purchases remain robust into late 2025, reinforcing the hard asset theme that spills over into silver with a lag, but more torque. ETF flows are on pace for a record year for gold, and silver ETFs in multiple markets have delivered triple-digit returns YTD, an attention magnet that pulls fresh money into the entire precious complex. This is not just anecdotal. Global gold-backed ETFs show powerful cumulative inflows this year. India's passive flows have been dominated by precious metals funds, and silver ETFs in particular have vastly outperformed domestic equities in several markets. That narrative conversion, "I need an allocation now," is exactly what precedes broad retail participation and institutional policy shifts. Second, the industrial bid. Silver's not merely a monetary hedge, it's a critical input for electrification, photovoltaics, power electronics, 5G/AI hardware, and advanced medical applications. The Silver Institute entered 2025 projecting a fifth straight structural deficit, with industrial demand at or near record highs again. That means even if investor flows cool for a quarter, the floor keeps rising because factories don't care about chart patterns. They care about feedstock. Pair that with tightening spot market conditions, rising lease rates, seasonal strength in India, and the revival of ETP demand, and you've got an engine that runs while pundits debate the RSI. Now, about the "where's the metal coming from?" question that anchors your timestamp on futures and delivery. The uncomfortable answer is from fewer and fewer places, and only at widening premia. We're watching a rare configuration. Record or near-record spot prices in London, massive registered eligible stocks stacking up in New York warehouses, and arbitrage literally moving bars back and forth based on a volatile basis between COMEX futures and LOCO London spot. When the LOCO price outruns futures by enough, metal migrates back to where bids are stronger. Recent reports flagged that very dynamic, spot in London over futures in New York, creating incentives to ship, even as COMEX headline inventories sit near the top of their historical range. The casual viewer hears record COMEX stocks and thinks glut. The pro understands that location, form, and deliverability matter more than tonnage in a PDF. Elevated inventories can coexist with tight usable liquidity when demand concentrates in specific vaults, sizes, and time windows, and when a lot of metal is spoken for. That was exactly the point Alasdair stressed about futures being used as a delivery pipeline, not just a casino. The China through line also matters for silver, even though the headline obsession is gold. China's build-out of exchange infrastructure, vaulting networks, and regional convertibility paths is shifting where price discovery happens. The Shanghai Gold Exchange adding offshore vault capacity in hubs like Hong Kong and Singapore isn't just optics. It's about making yuan-denominated physical settlement more convenient outside the mainland. Meanwhile, wholesale Chinese gold demand rebounded even with RMB strength this year, and price records in Shanghai have stacked up session after session. All of that feeds a broader hard asset premium in Asia that tends to drag silver along, especially jewelry and investment bar demand in India, where seasonality and culture amplify every up move. When we get cross-market bursts where Asia is price setter and the West is price taker, premiums can behave in ways that surprise New York and London desks. That's why Andrew's anecdote about delivery queues and vault flows resonates right now. Bring this home to the U.S. because that's where policy is adding fuel. The current administration's tariff regime, anchored in a universal 10% baseline with reciprocal surcharges on key counterparties, lands squarely on the input costs of a highly import-dependent economy. Tariffs don't just nudge CPI a few ticks. They rewire pricing power across supply chains, pushing businesses to pre-buy, hoard, or hedge in real assets. That is inherently bullish for precious metals, which don't carry counterparty risk and sit outside Washington's fiscal experiment. Analysts have already translated those tariff layers into a household-level tax wedge for 2025. Regardless of where you land politically, it's a wedge that heightens the case for owning monetary hedges. Pro-metal viewers understand this intuitively. When policy accepts higher import prices as a tool of statecraft, it implicitly accepts a weaker currency path, or at least a less predictable one. Silver thrives in that ambiguity because it is both money and metal, hedge and input, so it catches two nets of demand at once. You'll also notice state-level politics quietly tilting the table. A growing number of states have passed sound money bills to reduce frictions, legal tender recognitions, tax exemptions on bullion, or, in some cases, the opposite, reimposing sales tax where exemptions once existed. The big picture isn't one uniform trend, it's a patchwork. But the directional signal is that precious metals are back in the policy conversation, not just in the portfolio conversation. Missouri and Texas have explicitly moved to make spending or holding gold and silver easier, while other states are tightening the tax net. For investors, that means where you buy and store matters more than it did 5 years ago. And it's another reason the physical versus paper distinction, so central to Andrew and Alasdair's argument, keeps widening. Back to silver's monetary optics. The gold-silver ratio hovered above 80 earlier in the year, which is historically rich for silver if you believe even a sliver of its monetary DNA still counts. If gold continues to be hoovered by central banks and sovereign wealth money, as it has been since 2022, silver becomes the democratized lever for everyone else. Family offices wanting torque, retail buyers priced out of four-figure coins, miners scrambling to finance growth as margins finally expand, and industrials that can't substitute away in photovoltaics or high-reliability electronics. In this setup, the ratio doesn't need to revisit Newton's 14-to-1 to deliver life-changing gains. Even a drift toward the low 30s in a bull gold tape implies outsized silver upside. You've already seen the market hint at this. The combination of tight spot metal, rising lease rates, and heavy ETP inflows is a classic precondition for virtuous cycle spikes in silver. One friction point I expect viewers to raise is the apparent contradiction between tightness and big COMEX stocks. It isn't a contradiction. It's the structure of modern metals logistics. Registered stocks are deliverable at that venue via that process, while eligible stocks meet standards but aren't necessarily for sale. Some inventory is hedged, encumbered, or economically unavailable except at premia that don't show up in headline price feeds. Another chunk sits in sizes that don't match the bars users actually need. Add in the basis games between futures and London spot, and the inventory overhang can coexist with a real scarceness where the next marginal buyer is hunting. That's precisely why we're seeing episodes where the futures curve and the physical market pull in different directions, and why you can get both record highs and stressed delivery pipelines in the same quarter. So where does the U.S. political lens, yes, including Trump, intersect with the silver thesis for precious metal partisans? First, tariffs are now a durable policy tool, not a campaign slogan, and they tend to raise volatility in FX, supply chains, and inflation expectations. Volatility is the friend of hedges. Second, the fiscal picture hasn't improved. Interest expense compounding is a structural tailwind to hard assets regardless of who staffs the West Wing. Third, the de-dollarization meme moved from Twitter to boardrooms after 2022. The fact that central banks in big emerging economies keep adding gold while the U.S. runs twin deficits is a reputational problem for the dollar, even if it never dies. In that environment, silver is the contrarian allocation that's still under-owned by institutions, still small enough to be overwhelmed by a few percentage points of portfolio rebalancing, and still absolutely mission-critical to energy transition capital expenditures. The pro-PM stance doesn't require apocalypse. It requires acknowledging that today's policy mix increases the set of macro paths where silver wins. Finally, a word to the wait for a pullback crowd. In normal cycles, you get 5 chances to buy the dip. In supply-constrained cycles, you often get 1, and it's terrifying because the tape feels parabolic. If you're running a U.S. book, think in layers. Some core physical silver that never leaves the vault, some torque through quality producers with balance sheet discipline and genuine reserves, and a rules-based plan for adding on volatility rather than price. And know your venue risks. State tax treatment can change, premiums can widen when you least expect, and ETFs are convenience with counterparties attached. As Andrew says, the West's paper game now takes cues from the East's physical market more days than not. Plan like that's true, and you won't be surprised when New York has the highest warehouse counts at the same time, London commands the highest offers, and Shanghai sets the urgency. That's not a contradiction. It's the new map of a de-globalizing world, and silver sits right at the crossroads. If you want to pin this to the exact beats of your cut, open with the BRICS/China liquidity framing, segue into the futures as delivery reality with this month's spot versus COMEX basis stories, and then land on the U.S. policy kicker, tariffs, deficits, state sound money legislation, before closing with the Silver First portfolio takeaway. Viewers who are already pro-metal will hear confirmation with new data points, record-setting spot moves and ETF flows, a 5th straight global silver deficit, and concrete policy developments that bias outcomes toward real assets. For everyone else, the argument is simpler still. When politics makes money less predictable, metal, especially silver, becomes the predictable part of the plan.